Realty Income has missed earnings 2 quarters in a row now, but I'm still buying, and here's why. What's going on, money lovers? This is Vinny from the Investment Club. Welcome back. So today I want to talk about Realty Income, and I want to mainly cover 3 things. So one, we're going to take a quick look at some important things to know about Realty Income. Then I'm going to show you a neat little trick about yield on cost and how you can actually make 10% a year on your money. And then we're going to look at their Q3 earnings and some of the highlights. Realty Income is one of my favorite REITs. It probably is one of the best REITs. It's very well diversified. It's almost a little index fund within itself. We'll get to all that later and some of their holdings. So if you look here, Realty Income's dividend is currently around 4.85%. Now keep in mind this is a monthly dividend. So if you have 200 shares of Realty Income, you're talking almost $50 a month you're getting in cash flow. Just sitting at home doing nothing just by owning Realty Income stock. That could pay for a cell phone bill, nice dinner, whatever you want. Now, the PE ratio is a bit high, but this is a premium company with great management, so you pay a little premium to own it, and I have no problem doing that. This is a company I know that I'm going to own forever. All right, so next up, let's go to Realty Income's website. I want to get to the earnings, but just so you know, they've gone over a 15% annual average return. And as I said, the dividend is growing around 4.5% a year. They've paid 600 consecutive monthly dividends. If we take a look at their Q3 earnings, you see here that this is a very solid company. It's generated above market average returns with below market volatility since 1994. So what does that mean? It is reliable. It's pretty consistent. One of the best REITs performance-wise, if not the best REIT of all time. So if we look at their portfolio, you see that in Q3 of 2020, they collected 93% of rent from their total portfolio. As you can see here, everything's pretty much returned to normal with the exception of the movie theaters, which are obviously still struggling. Other than that, everything is basically back to full rent collection. They're very well diversified, and what I really like about this REIT is that it's not tied to a specific sector. As you can see, they are very diversified across various industries. So it's essentially almost like owning a little REIT index fund. As you can see here, their rent collection from the top 20 industries. So while theaters obviously are still having a problem, they do only make up 5.8% of Realty Income's total rent. And the health and fitness centers make up about 7.2%, but those are back to over 80% collection. Theaters are only at 27%. This chart gives you a good idea of the consistency you can expect from Realty Income. They've had positive earnings growth in 23 out of the 24 years that they've been a public company. They've been able to grow their earnings on average a little over 5%, while other REITs have been 3.3%. If you compare during the financial crisis how they stacked up against the other REITs and their competition, in 2008 they made money in 2 of these 3 years and only lost 2% in 2009. While other REIT average growth rates were negative every year. Realty Income did significantly better. This chart basically is showing their downside volatility, which Realty Income's is 3%, which is the lowest of all S&P 500 members other than J&J and ROST. So what that means is Realty Income is very consistent, very steady and reliable. Johnson & Johnson is another great company, and I'm going to do a video on them soon. So Realty Income will give you consistency, good returns, and it's a pretty conservative investment to make. If you invest in Realty Income since 1994, you would have made on average a little over 15% a year as compared to the other major indexes. If you see S&P only averaged 10%, so it's outperformed the broad market, and it's also outperformed REIT indexes. The reason Realty Income does so well, they have great management, and they don't just take on any tenants. They focus on quality underwriting and invest in businesses that they know that they can expect predictable cash flow generation. And as you can see here, they've had consistent occupancy levels. They've never gone below 96% occupancy. They're still thinking long-term, acquiring strategic properties. They remain disciplined. They're, like I said, they don't just take on any tenant. They execute long-term net lease agreements, which you want to see. You don't want to see a lot of turnover year to year because with that comes more risk. We look at some of their tenants. These are their top 20 tenants, and as you can see, They are spread out through, very diverse industries here. We've got Walgreens is number one, 7-Eleven, Dollar General, FedEx, Dollar Tree. The only thing that worries me here is really the theater percentage, which, a little over 5% is not the end of the world, but it is a larger exposure than I'd like to see. You can make the same argument for the gyms, but that being said, I think humans are social creatures, and when things get back to normal, I think people are going to keep going to gyms. Gyms are not going to cease to exist. People want to socialize, they want to go to the gym, take classes with other people, and the same goes for theaters. To some extent, I'm sure that they are going to be something that sticks around, and if not, another business will move in there and Realty Income will have a new tenant to rent to. I'm really not worried. It would be nice to see Realty Income increase their revenue from things like Walmart, Home Depot, CVS, because these are things that are staples. They're not going anywhere, and maybe you will see that as some of these businesses go under. Realty Income is obviously going to take on defensive tenants that are reliable. As you can see, they're well diversified. They have exposure to 51 different industries, 81% of their total rent. Now, 84% of their rent does come from retail, and this is something I would like to see. I spoke in my previous video, which I'll link in the description below, about a company called RioCan, which is essentially the Canadian version of Realty Income. They're moving more toward residential and mixed-use properties, which that's something I would like to see from Realty Income as well, because obviously that's a lot of concentration in retail, which is an industry that is rapidly changing. But that being said, a lot of these stores are staples, and they're going to do just fine. Retail will not cease to exist overnight, and they do have exposure to other types of properties, but I definitely would like to see more residential. So this is just something to keep an eye on, especially with the possibility of a second wave of the pandemic. As you can see, they're pretty well diversified. They have properties in pretty much every state, as well as in the United Kingdom. So as I said earlier, as you can see, their top 20 tenants are kind of protected from changing consumer behavior. These are companies that have a moat, barrier to entry. They're not just going to go bankrupt overnight because they all fall into at least one of these categories that Realty Income screens their tenants by. They either offer a non-discretionary service, they have a low price point, or service retail or non-retail. And as you can see here, Realty Income was not majorly impacted by many of the retail bankruptcies that we've seen in the last few years because they don't invest in these types of companies. As you can see, they have less than 1% exposure to most of these companies because they wouldn't fit those 4 categories. They have to meet these prerequisites for Realty Income to even consider them. So this is a company that I can confidently say I will own forever. They have very competent management. They have a very high rate of releasing of their properties. Because of their screening procedures, they have a high recapture rate. They only take the best of the best. They have high quality tenants, and that's one of the reasons why I don't see this company ending up in trouble and ending up like a Simon Properties type of REIT, where you see now they own a lot of the malls and all the stores are going out of business and they have a big problem. I think Realty Income is worthy of a spot in every type of portfolio, whether you're looking for growth. This company, as we saw, has got a 15% compound annual growth rate, which has outperformed the broad market. It's great for cash flow. You can get paid every month. The dividend is monthly. This company is going to be around for a long time, and I plan to keep and continue to dollar cost average in. And as a bonus, they also are striving to be a leader in these ESG categories, which the trend is moving in this direction. This is something that will only become more and more appealing to investors, I think, as time goes on. So let me know what you think in the comments below, and if you own any other REITs. Let me also know what company you want me to do an analysis of next. Enjoyed the video so far, don't forget to like and subscribe. It really helps out the channel. If you're still here, I have a little bonus for you. I wanted to talk a little bit about yield on cost and how you really start to maximize your income from dividend paying stocks. So as you can see here, in the bottom of the pandemic, Realty Income in March was all the way down. It actually got, if we look at the 52-week range, all the way down to $38 a share from a high of 84. So I just want to take a quick look and show you yield on cost. Now, this seems more complicated than it is, but think about this as when you put your money in your bank account or in a CD, you're getting an interest rate. Let's say on your bank account, it's probably something like 0.01% right now, or maybe on a CD, it's 2%. Either way, not a whole lot. So if we look at Realty Income, we see their starting yield is 4.85%. We'll plug that in. Their dividend growth rate, I'll show later, is around 4.5%. So they're growing it by over 4% annually. Now let's just say you held 100 shares and your cost per share was that low of $38 a share back in March. And let's just say 10 years you're holding it. So you started with this investment, you've pretty much doubled your money almost. So after 10 years, you're making an average gain of almost 8%. But the part I really want to emphasize is that if you look at your yield on cost, by year 9, it's over 10%. So each year, if you were to keep reinvesting your dividends, this number continues to increase. But think about it like this. So now by year 9, you're getting 10% interest on your money. Now, obviously, stocks come with inherent risks, and it's not entirely the same as a bank account, but this is the best way, I think, to make people really understand and think about this. 10% interest you're making on your money every year to do nothing. This is if you never added any additional money. You just bought those initial 100 shares, $400 a year. If you kept adding to it every year, this is going to be even higher. So this is the power of long-term investing, letting your money compound. Now, you're probably saying, all right, well, that's great and all, but you can't time the market. But the reason I use this $38 price point is this stock continually goes up every year. So even if you were to buy it where it is right now, like I have been at around, let's just say $60 a share, let's say in a year from now it's back up to 80, probably even higher. Let's say 90. This is where you can apply those same types of calculations. Figure that's another 50% gain, but since you bought in at 60, you have a higher yield on cost. If you have any questions about yield on cost and compound interest, let me know in the comments below and I'll make an in-depth video on them if you want to learn more. As always, this is Vinny from the Investment Club and I'll see you next time.